Welcome back, everyone, to the Audacious Witch channel, where we talk about the magic behind the stock market. The oil markets just delivered their biggest signal day surge in over 2 years, with WTI crude rocketing nearly 9% to touch $77.62 following Israel's latest strikes on Iran. But before you get caught up in the headline-grabbing World War III drama, take a step back and look at what the charts are actually telling us. We can see JP Morgan are calling $130 oil. CNBC Pro is calling for oil to be over $100 a barrel. Is oil price really going to get that high? How will it affect our stocks? Let me explain. The parallel channel pattern on WTI's daily chart tells a compelling story that has nothing to do with the Middle Eastern politics and everything to do with market fundamentals. Despite yesterday's dramatic surge toward the upper boundary, the underlying technical and fundamental picture points decisively lower. We have a perfect parallel channel. What immediately catches my attention about this WTI chart is the mathematical precision of the parallel channel formation. The upper resistance line and lower support line are running in perfect parallel alignment, creating clearly defined boundaries that have contained price action through multiple channels. This isn't some loosely drawn channel, it's a legitimate parallel structure that has provided reliable entry and exit points for months. The recent spike to $77 represents a test of that upper channel resistance, but notice how price action has already begun to pull back from those levels. This is classic behavior we see when geopolitical premiums get slapped onto oil prices. The initial surge captures all the fear and uncertainty, but then reality sets in as traders realize the actual supply disruption may be far less severe than the headlines suggest. From a pure technical standpoint, parallel channels like this one typically resolve with price returning to the opposite boundary, given that we just tagged the upper resistance around $77. The mathematical target becomes the lower channel support, which sits right around $53. Let's put this current situation into historical context because we've seen this movie before. When Iranian forces attacked Saudi Arabia's oil processing facility in September 2019, a facility that processes 5% of global oil supply, prices initially spiked. But within just 2 weeks, satellite surveillance proved that Saudi Aramco had repaired the damage and used inventories to maintain export levels. Brent crude prices were back at pre-attack levels before most traders had finished updating their risk models. The pattern is always the same. Initial panic, price surge, then gradual realization that the global oil system has built-in redundancies and workarounds. Today's markets are even more resilient than they were during previous crises. With better intelligence, strategic petroleum reserves, and coordination mechanisms that help mitigate supply shocks. Iran's threats to disrupt traffic through the Strait of Hormuz sound ominous. And yes, about 30% of seaborne oil trade flows through that narrow waterway. But as JP Morgan's commodities team points out, despite countless threats over the decades, the Strait of Hormuz has never actually been closed off. Crude oil has continued to flow through every crisis, and there's no reason to expect this time to be any different. Supply abundance meets weakening demand. While traders are fixated on Middle Eastern headlines, the real story is playing out in supply and demand fundamentals that paint a bearish picture for oil prices. Let's start with supply. U.S. crude production hit a record 13.2 million barrels per day in 2024, with the Permian Basin alone pumping 6.3 million barrels daily. That's a staggering amount of oil flowing from American shale fields, and it's fundamentally altered the global supply equation. This surge in U.S. production isn't a temporary phenomenon. It represents a structural shift in global energy markets. The Permian Basin has become so efficient that break-even costs have dropped to around $62 to $64 per barrel. Even at current prices, American producers are making money hand over fist, which means any sustained price rally will only encourage more drilling and more supply. But the real kicker is what's happening on the demand side. Global oil demand growth has been revised sharply lower for 2025, down to just 730,000 barrels per day, according to the International Energy Agency. That's the slowest growth rate in 5 years, driven by trade tensions, economic slowdown fears, and the rapid adoption of electric vehicles, particularly in China. Speaking of China, the world's second largest oil consumer has seen its oil demand essentially flatline since 2023. This is huge. For years, China was the primary driver of global oil demand growth, but a combination of economic restructuring, demographic changes, and the EV revolution has changed that dynamic permanently. When more than 40% of new car purchases in China are electric or hybrid, you know the transportation fuel landscape is shifting beneath our feet. Global oil supply is expected to exceed demand by 1.2 million barrels per day in 2025. In the market that's already oversupplied, geopolitical risk premiums have a tendency to evaporate quickly once the initial fear subsides. The broader economic picture provides another layer of bearish pressure for oil prices. U.S. economic growth is projected to slow to 2.2% in 2025 and just 1.3% in 2026. Trade tensions and tariff policies are creating additional headwinds for global economic activity, which directly translates to lower energy consumption. This economic slowdown isn't purely theoretical. It's already showing up in real-time data. Industrial production growth is decelerating. Transportation activity is moderating. And even the traditional resilient petrochemical sector is facing headwinds. When the economy slows, oil demand follows, and that's exactly what we're seeing play out across multiple indicators. The parallel channel pattern I've outlined provides a roadmap for navigating this volatility. While geopolitical headlines will continue to create noise, the technical structure suggests that prices will ultimately gravitate toward that $53 lower channel support. That's where fundamental value appears to reside given current supply and demand dynamics. We need to acknowledge the risks to this bearish thesis. If Iran actually follows through on threats to close the Strait of Hormuz, or if Israeli retaliation significantly damages Iranian oil infrastructure, we could see prices spike well above current levels. JP Morgan estimates that oil could reach $130 per barrel in such a scenario. But the probability of such extreme outcomes remains relatively low based on historical precedent. Both Iran and Israel have strong incentives to avoid actions that would create sustained economic disruption. And other major powers have even stronger incentives to prevent such outcomes. The most likely scenario is that oil prices will continue to face downward pressure as the initial geopolitical shock fades and fundamental realities reassert themselves. Supply abundance, weakening demand, and economic headwinds create a powerful combination that argues for lower prices ahead. The bottom line The current spike to $77 represents a selling opportunity rather than the start of a sustained rally. For traders and investors willing to look beyond the headlines and focus on the technical and fundamental evidence. The parallel channel formation provides a clear roadmap. We're likely headed back to $53 and possibly lower as reality trumps rhetoric in the oil markets, so I sold out of my Oxy stock for now, as I only hold my SU stock for the upside hedge. Lower oil prices signals higher unemployment rate and recession. It seems like we are repeating 2008 all over again.